All right, good morning, good afternoon, everyone, and welcome to our webinar of the month of October. It's been like the fourth time that we are doing this webinar. It's always a big pleasure for me to talk about the markets and our investment outlooks. If you have questions, there is a field where you can type in the questions, so I can try to answer your questions towards the end of the webinar. I try to be relatively short today, maybe 30 minutes or less, and we'll give you a short summary on what has been going on in the markets, and I will present you also our current asset views and model portfolios. So for those of you who joined the first time, my name is Pascal Rohner. I'm the CIO of Katch Investment Group. Katch Investment Group is a dynamic asset management boutique. We are focusing primarily on private debt. So we are currently managing different investment vehicles that invest in private debt in different segments. And apart from that, we also offer advisory services for smaller financial intermediaries or independent asset managers, a service where we provide views on asset classes, financial products, and so on. And we call this service CIO outsourcing. So I'm going to start with the markets. Just a very brief summary on what has been going on in terms of economic data. I think the last time we didn't really focus that much on economic data. I think this time it's a bit more important. First of all, if we look at the surprise indices, which sometimes are even more important to see than actual economic indicators, because what typically moves markets is more like the economic surprises and not the actual figures. And we can see here that if you look at the surprise indices, you can see that until recently in the US, the momentum has been pretty positive. So most macroeconomic figures have surprised positively in the US, while in Europe, in the Eurozone specifically, the data, which has been disappointing since 2018, has continued to be very weak over the last couple of months. But what you can also see is that just very recently, in the last days or the last week, the US numbers have started to come down a little bit. And one of the most important indicators that came out last week is the PMI data. I think it was very important, and the market reacted accordingly. So first we had the manufacturing data, the ISM manufacturing PMI, that came in pretty low at 47.8, which was clearly below market expectation. It was the lowest level in basically since the big crisis in 2008. And it's a bit, I mean, last time or maybe 2 months ago, we showed you the global PMI figures. So the US was basically the only market that was, I mean, just at 50, and previously it was above 50, while in the rest of the world we had already a big crisis in the manufacturing industry. And now it looks like the US cannot be isolated anymore. So we can also see that US manufacturing is affected by mainly by the trade war that is going on. So, but the figure was much worse than expected, and the markets sold off. And then, I mean, it's still not really a huge alert, because in the US, as we know, manufacturing is only around 20% of the GDP. Services is much more important. So we looked at the services PMI that just came out 2 days later last week, and it was also disappointing. It's still above 50, which is the good news. It's at 52.6, but also it was below expectations of 55. And we can also see, if we look at the chart of the ISM non-manufacturing and manufacturing, for both indicators, I mean, it can be volatile, but the trend right now is clearly negative. So the big question mark is obviously, as we know that manufacturing is in a crisis, and it's probably not going to be solved anytime soon. The big question mark in the US is obviously whether the consumer and the services part can be resilient and unaffected by, let's say, the manufacturing crisis. So apart from the ISM non-manufacturing, which was a bit weak, but above 50, I think a lot of investors and economists have been focusing on the strength of the labor market. And last week we also had the labor market report, so it was very important. It was very busy week last week. So last Friday we saw that the U.S. economy created 136,000 jobs, which was a bit less than expected. The expectation was for 145,000, but still it was somehow okay, because I think probably the market expected maybe even a bit a lower figure after the very weak survey data that we got from the PMIs. And it was more or less in line in terms of job creation. So it's not a big deviation. Still, we can see that the job market is slowing a little bit. So the average has been coming down, but this is completely normal, because right now we are like in a late stage of the economic expansion, and basically we have full employment. So it's normal that the pace of new job additions has to start to come down a little bit. But at least for now, it's just a normal slowdown, and it's really not falling off a cliff. So this was a bit of a relief for the markets last Friday. So we saw a big rally in equity markets last Friday, because the job market was much more resilient than expected. And probably even more importantly, if we look at the unemployment rate, which was a bit weird to see that the job growth was lower than expected, but at the same time, the unemployment rate fell to 3.5%. Versus 3.7% expected. And this is really a figure that is really outstanding, because if we look at the chart that I brought here, you can see the unemployment rate and recession phase since the 1960s. So we can really see that we now basically reached a new 50-year low in terms of unemployment in the US, which is usually really an indicator that is also a leading indicator, and it really doesn't signal a big recession risk right now. So the job market has really continued to be very firm, and you can see during recession periods, usually the unemployment rate can be relatively low, but if we get in let's say economic turmoil, it would start to increase pretty rapidly. And right now, there's just no real sign that this is going to happen. I mean, it could happen. It could happen next year. It could happen somewhen if we get like a more contagion, let's say, from the manufacturing industry towards other industry. But so far, it's too early to talk about recession. And most economic models point to a relatively low to moderate recession risk for the next 12 months. So I would say that probably the risk is around 30%. But of course, it depends on a lot of political developments right now, which makes it a bit harder to predict what is going on with the markets. What was also an important figure last week when we look at the job report was that the wage growth was only 2.9% in September versus 3.2% that we had in August. So which is somehow good and it's somehow bad. It's good because wages are not really causing a lot of inflation pressures, which probably also means that monetary policy can continue to be very expensive. So we might see further rate cuts going forward. I'm going to talk about that in a second. But on the other hand, we can also see that if the US is a consumer-driven economy, you would also like to see wages going up, because this strengthens the consumer force, and this is not really the case. So one explanation is really that because really the economy is expanding, and we are in a late stage of the cycle, you see again that lower skilled workers are coming back into the labor force. So and the wage growth, let's say, for lower skilled workers hasn't been very good. So I think you see somehow a dispersion between labor shortage for some higher skilled workers, and at the same time you have let's say a big force of people that are re-entering the labor markets if they can, and not necessarily getting a much higher salary. And also the mix between lower and higher skilled workers, if you have more lower skilled workers entering the force, means that on average, earnings they don't go up that much. So right now it's still okay. I think that the market was very fine with the numbers because it was not too, like, once again, not too hot, not too cold. One can say the economy is doing more or less, and it's not certainly not overheating. So which also means that we can certainly see some more rate cuts. So actually, if we look at the monetary policy expectations for the next 12 months, it has been a bit volatile. So what you the chart here, it basically shows what is the number of rate cuts that is anticipated by the markets for the next 12 months. So after the market rebound that we had towards the end of September, we could see that the market and also treasury yields, they rebounded. So we could see that less rate cuts were expected by the markets. But now we are basically down again to 3 cuts. So most likely we're going to see a next cut now in October, where we have a probability of a cut of 70%. This percentage number has come up quite a lot now in the last couple of days. So we're going to know soon whether we're going to have an additional rate cut in October. Probably it depends also a bit on some of the political noise that we're going to get in the next couple of days. We will see, obviously the most important thing is that we have the Chinese delegation, very high level delegation that is going to the US on Thursday for the trade negotiations. Right now, we have heard some noise since yesterday. So probably you all saw the news that the US put 28 Chinese companies on the blacklist, which basically means that they cannot do business with American companies without a license. And it's a bit something new and something important, because it's the first time that the US took such an action based on human rights. So what they basically see is that the Chinese are violating human rights in some areas, violating the rights of some minorities and so on, which is really brings also the trade war a bit to the next level. And also the Chinese, they responded. They're probably gonna take action on that as well. So it's like a small escalation before the talks. It's not the first time that this happens, but it's something that it's obviously making a big deal very, very unlikely in my view. So if we heard the last couple of interviews from President Trump, he was still talking about a full deal or no deal mentality. He said it's unlikely that we just have a small deal. He wants to have a big and full deal. But this is extremely unlikely, because some of the very big topics like intellectual property topics and government subsidies in China and so on, they haven't really been discussed. So it's really, it would be a very, very big surprise if we would get a deal in these areas. So I wouldn't expect that. If we get a deal, I mean, of course, then markets could rally, because a lot of market participants are very skeptical going into the talks. But if we don't get a deal, probably going to have the same sort of environment, which is more like a range-bound environment. So if we look at treasury yields in the US, at the bond market, after a short rebound that we saw recently, now we are basically again down to very close to all-time lows in terms of US government yields. I think when I checked in the morning, the US 10-year yield was at 152. So it's a pretty low level. And our base scenario is still that we get some worse economic news over the next couple of months. It's also common sense that the monetary policy action, they don't have an immediate impact on the economy. So usually you have a lag of up to 12 months or even more. So it's unlikely that we get a stimulus just because of the recent rate cuts and the rate cut that is coming now in October. And probably we're going to have some more weakness in economic data, which also might push yields further down. The only thing that could stop the trend of falling yields would be a trade deal. So we're gonna know soon. But as I said before, we are very skeptical, so we don't really think that it's gonna happen. So eventually we're gonna have like a mini deal, even though Trump wasn't very positive on doing mini deals, but a quick and easy win, an easy goal would be just to have again a commitment from the Chinese to buy more U.S. agricultural products, because this is basically good for both sides. So the Trump has something to show to the farmers, also going into the campaign, which is a bit of a troubled area. And also, number two, the Chinese, they really need the commodity imports. So, which would be a positive impact for the Chinese as well. If we look at the S&P 500, as we said before, the market has been very range bound. And it's interesting to see that actually we have had basically no performance since January 2018. Okay? I mean, it has been pretty volatile, but if we look at the last 18 months or so, the market has been relatively flat, maybe a very moderate uptrend. And it's really struggling to reach new highs. For those of you who have been following our views and webinars and articles and so on, have seen that we basically recommended to be slightly underweight equities in July, when the S&P 500 for the first time was about 3,000. So then we said, look, probably it's going to be volatile, but the upside is a bit more limited now, so we took it down. And right now our base scenario is still that we're going to stay range bound in the S&P 500, which can give some trading opportunities from time to time. So the range that we see is mainly, I would say, between 2,800 until 3,150. So if we get a bull scenario, let's say of a somehow encouraging deal with China, we might see a market rally, but we think it's going to be relatively short-lived, and the market is going to remain in this range, mainly because we're not going to have very positive economic data over the next couple of months. For 2020, the situation can change. If we have a de-escalation in terms of trade, there are some indicators that points towards some relief in terms of economic data. And we might see a reacceleration of economic growth somewhere in 2020. But this is really much related to the current trade talks. So we have to be we have to monitor basically what's going on. And we're going to see. Right now, I would stay cautious in terms of equity exposure. And what we recommended basically to investors when we went slightly to underweight in equities is it's important not to be overly active. It's not good to sell and buy too much. So it's just a somehow reduced exposure in terms of equities. And at the same time, instead of selling all equities, what we recommend is to have some protection in place in terms of portfolio management. So what we did is we built up an exposure of 5% in US Treasuries in a normal portfolio. We started this process last year when the Treasury yields were still above 3%, and we continue to believe that this is a good investment because, as I said before, probably yields are going to go lower. And also we started to buy some gold as a protection in the portfolio. When in terms of other catalysts for the markets going forward, apart from the trade talks, I mean, we obviously also have Brexit. Brexit is a bit, sometimes it's a bit boring to talk about Brexit because it's like a never-ending story, and one feels like one deadline is chasing the next deadline. So we're going to have a deadline for Brexit very soon on the 19th of October. And the most likely scenario, as I mentioned before, is that there is not going to be a deal. So right now there is still there's a wide gap in terms of expectations from the EU side and Boris Johnson, mainly around the Irish backstop, which looks like it's not going to be solved in the very near time. So there's not really a way that he can do a hard Brexit right now. So we believe that he would need to seek an extension from the European Union, and then probably seek a new general election in the UK, which is going to happen somewhere in the next couple of months. which might improve or worsen a bit the scenario to get a deal, or at least we will see whether there is enough political capital to get a deal done sooner or later, or even enough political capital to be able to do a Brexit without having a deal, which right now looks very unlikely. So I would say that the risk of a hard Brexit is maybe 10% or below. The risk of an extension is the main scenario. Extension, and then when later on, after renewed elections and so on, maybe to have an agreement with the European Union. But which is a bit the same that we see in the trade war between the US and China. So we're going to have some ups and downs, but not really a solution right now. So which basically also confirms our view on the market, that we're going to have more like a range-bound equity market. Now, another catalyst that I just quickly want to mention is the earnings season that is starting now in the US. It's a bit the same picture as we saw in the last 2 quarters. I mean, you remember in the first and the second quarter, the expectation was, in terms of analyst expectation, was that we would get a slight earnings recession in Q1 and Q2. But at the end, earnings were basically flat, because you typically have a surprise ratio. That's what's always happening. Before the earnings season starts, you see usually that analysts are revising the estimates, and you have negative revisions, expectations go down, and then the companies basically beat expectation. It's not really true in Europe and the rest of the world, but in the US, the communication always works like this with the analysts. So at the end, you're going to have a 70% beat ratio, more or less, and you're going to have a 2 to 3% positive earnings surprise. Can be a bit more, can be a bit less, but that's usually the playbook. So going into the Q3 earnings season, expectations are -4% in terms of EPS, and probably we're going to end up having 0, -1, or -2%. So slightly negative, but not that severe, which is not too bad. But at the same time, we don't have the strong earnings momentum that we had towards the end of 2018, when companies still benefited from the fiscal reform in the US. So right now, economic growth is relatively slow in the US. So we had 2% GDP growth in the second quarter. Probably Q3, Q4, it's going to be maybe slightly below 2%. We wouldn't be surprised to have towards the end of the year a GDP growth of closer to 1.5%. Not in recession territory, obviously, but the slowdown continues. So the outlook of the companies that are going to report earnings right now, also given the PMIs and so on that we had, depending a bit also what's going to happen now with the trade discussions. But assuming that there is not going to be a big deal, probably the guidance is also going to be relatively cautious. So I don't believe it's going to be a huge catalyst for the markets that are going to push equities much higher right now. So I'm not going to go too much into the detail of our asset views. I mean, for those I think we sent our monthly publication with all the details, so you can read it afterwards. So what we have is basically our views on the different asset classes: equities, fixed income, and alternatives. As you know, given the low yields in fixed income and our underweight in equities, we are extremely bullish in alternatives. So we added gold, but our main high conviction call remains private debt, where we have a huge, very interesting return potential with very strong guarantees. So we basically believe that if you are not in equities, you can have other alternatives, but if you are underweight fixed income, you need to have fixed income alternatives. So we believe that fixed income alternatives is really the place to be still. And if we look at our model portfolios, I mean, model portfolios, I think it's very important to work with model portfolios always, because it makes you just much more disciplined with the approach with investors and private clients. And it's very important to use the profile as guidelines in every client discussion. So for example, if we talk to a moderate client, which at least in Latin America, for example, you have 80% of the clients are typically moderate, so the profile is very conservative. Currently, we would only recommend to have 23% in equities in this profile. We have 40% in fixed income, and we have 35% in alternatives, and then a little bit of cash. If we look at balanced, which is more like the standard portfolio, if we talk to US investors or maybe European investors with a longer time horizon and with a more aggressive profile. So currently we would recommend 42% in equities, 18% in fixed income, which includes the holdings we have in US Treasuries, just to have some protection in the portfolios. And we would have 38% in alternatives. Now in the moderate portfolio, 20% within the 35%, let's say half of it, a bit more than half of the 35% that we have in alternatives in the moderate portfolio would be private debt. In the balanced portfolio, it's obviously possible to also to include a little bit more of private equity and more aggressive products. But if you want to be conservative, private debt is really still the place to be. So with that, I think I finished my presentation. So as I said at the beginning, if you have questions, you can type in the questions in the Q&A field in the Zoom application or in your desktop, and I can try to answer your questions. Otherwise, you can also contact me later on and we can have a direct conversation on different topics. As always, we have a very limited time to do the webinar. There's so many topics going on right now. So I'm really happy to discuss any other topics directly with you. So I'm checking the questions right now. So we have actually one question. And the question says, why did you choose to hedge your portfolio with treasury calls and not equity puts? I mean, what we basically did is not treasury calls, but we did treasury bonds. I mean, maybe it's just a way of saying it. So we bought treasuries because we believe that if you get into a more like a deflationary environment and yields go much lower, you would have like a negative correlation between stocks and bonds. So basically bonds go up and equity goes down. Of course, this is not the only way how you can hedge a portfolio. And we are completely aware of it. Gold would be another hedge, which works sometimes it doesn't work. But gold is very good if you have more like a systematic crisis, or if you have like a confidence crisis in central banks or the banking system generally. Also, if you have an inflationary shock, I don't believe that's going to happen, but this would be another scenario where we would have a positive environment for gold. So right now, our call on gold is more like because we believe that markets are losing a bit confidence in the central bank's independence. You can see it in the US, where you have constant tweeting around policy actions, which I don't believe it's a very positive environment. So I think gold can give you at least some protection. We have a high debt levels overall, and it's really, it can happen that the market will get the perception that central banks might be used to do fiscal stimulus, to reduce interest rate in order to be more aggressive on the fiscal side, which is obviously very bad if you look at currencies and so on. So if you have alternatives like gold, it gives you some protection against this scenario, against these fears. And finally, the question is, why don't you do equity puts? I mean, it's always possible to do equity puts, but equity puts, it's more like a tactical instrument, because if you buy like a lot of options all the time on your equity portfolio, it's a big drag on performance, right? Because it's a cost. So if you have to pay, for example, 1.5% for a 3-month rolling hedge on your equity position, for a whole year, you're going to pay 6%, which is going to eat your whole return potential that you have on your equity portfolio. So if you want to time the market and you believe that the market is range bound, which we also believe, and you go towards the upper bound of the range, and you feel like you want to hedge a bit, but you don't want to sell for tax reason or for any reason, or just because you cannot, or that maybe the portfolio is not that liquid, or you like the stocks that you have. So you can do tactical hedges. You can hedge a little bit because you believe that the market is going to go down in the short term. You do it and you're protected, but it's not an instrument that is recommendable to do constantly, because it would just be a too much drag on the portfolio. So the best advice in terms of protect the portfolio, in our view, is not to be overly tactical, but rather to diversify as much as possible. And this also includes some fixed income securities, some alternative securities, and especially it's very important to have pretty big holdings in alternatives that are not correlated to traditional assets. You know? Because if you do traditional assets, you can buy commodities, but commodities are usually highly correlated to equities, especially base metals and oil and so on. So you have a high correlation. If you do hedge funds, most hedge funds, like long short hedge funds or even global macro funds, from time to time they have a high correlation with traditional assets. We saw in 2018 when hedge funds were down and equities were down and fixed income was down. So I think it's better to have something that is in the private market instead of the public markets. So instead of equity, to have a little bit in private equity, and instead of fixed income, to have a little bit in fixed income alternatives, because typically you don't have any correlation with these quoted and very liquid asset classes. So it's better to be a little bit less liquid, and this gives you a lot of protection in terms of your portfolio profile. All right, we don't have additional questions at this stage. So as I said, you can contact me anytime. And well, thank you so much for attending this month's webinar. We're going to do the next webinar in a month's time. And as always, it's going to be very interesting because we have a lot of things that are going on in the next couple of weeks. So we're going to have, as I said, the trade talks. We're going to have the Brexit deadline. We're going to have the Fed meeting at the end of October. And we're going to have a couple of important macroeconomic news that's coming in. So there's going to be plenty of stuff to talk about next time. So thank you so much for your attention.